Hi, it's Alicia. I wanted to give you kind of a quick video on what mortgage insurance is and kind of explain it a little bit better. So this is the main difference between an FHA loan and a conventional loan, which is mortgage insurance. Mortgage insurance is when you don't have 20% down. So if this is 100% and this is 0, you need to come up with 20% down. However, most people don't have 20% down. So what we do is we have mortgage insurance. And FHA has its own mortgage insurance, and conventional we use companies like MGIC or Radian or a few different companies. And what they do is they ensure that if you default, they will pay the difference from the 100% or the 90% or whatever we choose together to the 80%. So if you default, they'll pay that difference. Now, you still owe it if you default. So basically it's money that goes into the trash can. So we want to try to avoid it, and there's different ways to avoid it, and there's different options to pay it. So we're going to go over FHA first, which is monthly and upfront. So you have to pay it 2 times, which kind of sucks, but it does make it more affordable in the monthly mortgage insurance. FHA never goes away, so you always have to pay it. Even if you get below that 80% and you're down here, you still are required to pay it. So if you look here on the worksheet, this is the mortgage insurance up front, and here's the mortgage insurance monthly on this particular borrower. Mortgage insurance for FHA is not contingent on your credit score, whereas conventional it is very much based on your credit score. So if we have mortgage insurance on this particular deal, you would pay $33.78 upfront and $137 a month. Now, this upfront is rolled into your loan amount. So as you can see, you went from $193 to $196. So if we kind of maxed it out for FHA, that's what you would roll into your loan, and then that's your monthly mortgage payment. So if we looked at this compared to a conventional financing, let's see, we'll do 336, 5% down. You don't have any upfront mortgage insurance, but you do have monthly. Now, typically the monthly is higher on conventional than it is on FHA, and also the rate's higher. So some people pick FHA just because their payment is lower. So we'll do the math and we'll figure out which one actually is the most beneficial for you long-term and short-term. And it's not always the same for everybody. So it's kind of one of those things that we need to look at your whole scenario and then decide which is going to be the best one for you. The other thing we can do is look at doing upfront mortgage insurance versus monthly. So if I take the monthly fee, I gotta scroll over, and we increase from, instead of doing it monthly, so sometimes if you have really good credit score, sometimes the monthly will be, we could do 0 and we could maybe do 2 points up front. So what that does is you charge $3,600 up front, but that you don't have to pay that $260 a month. So it actually makes it cheaper. But you cannot roll it into your loan amount. You could have to pay it up front. So it's a little bit different on how that works, but it is, if you have a really good credit, it's a really good option. If you have low credit score, then your mortgage insurance for upfront is so expensive that it's usually better to go ahead and do it monthly. So we can look at different options. If you have any questions, let me know and we'll go through it. Thank you. Have a good day.